This is super cool, and I think this is a great way to start off the session today. You've got some really, really amazing panelists here who are going to be looking at things from a totally different perspective. I mean, arguably, you've got someone who sits in a seat that has the biggest bank in the world behind them. You've got someone who's got one of the largest pension funds investing in this space as well. You've got someone who clearly represents what I would say is one of the biggest success stories of the crypto space, at least here domestically. And then obviously someone who's just trying to disrupt all of it and has been trying to do it for some time now. So I think we'll kick things off a little bit here today. And I think it starts with a simple question, which is why does it all matter, right? Why are 400 people here? Why are we all here? Why have we been working so hard to do this? And why does it matter? What does tokenization really mean from that perspective? And I'll start with you, Robert, just because you're over on that side, and let you kick this thing off.
Yeah, so I think the reason why tokenization matters is that right now there's about $1 trillion of assets on blockchains. And all of those assets are crypto native assets that were born and have grown up on a blockchain. And there's hundreds of trillions of dollars of assets that don't touch a blockchain, don't have the benefits of a blockchain, aren't programmable, aren't transparent, aren't interoperable in the same way. And what I think matters is this very slow, very important, very public migration of assets on chain. And tokenization is the opportunity to take assets that aren't born natively on a blockchain, but bring them onto a blockchain to have additional utility, additional programmability, and become better assets. And I think this is one of the most important trends in finance over the next 30 years. And I think everybody here recognizes that in some way, and that's why I think we're all gathering together.
Cool. So Anthony, I mean, think about this from a Coinbase perspective, right? I mean, many people talk about, tokenization of real world assets, and they talk about the operational efficiencies, right? The cost, the fractionalization. How does that come into play when you take a look at someone from your seat?
So I think we've hit peak efficiency with legacy technology in terms of investing. And so we've maximized. So if you think about the different product sets as a multi-asset portfolio manager or a multi-asset investor have to use to invest, we've got pretty efficient equity markets, we've got semi-efficient fixed income markets, we've got efficient futures and options and swaps markets, right, that are running trillions of dollars of risk globally. Putting all that stuff together in a multi-asset portfolio construction framework is actually tremendously difficult and challenging, and only the largest institutions in the world can afford to do it. Smaller players can't afford to do it. And that's because of the challenges and just the sheer walls you have to break through from a regulatory perspective and from a technology perspective. So we've hit max efficiency in terms of how good finance can be today. So when we're thinking about why this matters today, for me, it's the next product, right? A token is going to be the next ETF and all these other things that we haven't really figured out yet what they are going to be. When I was at my prior firm at BlackRock, I spent 10 years there doing, fast restructuring solutions. We do $300 billion events per year for clients where we'd be restructuring their portfolios across all asset classes for them. And we'd use every product in the toolkit to do that, right? But you'd always hit a point where you're like, I can't get down to that risk factor. I can't get that customized exposure that I really want to get to solve my institutional clients' needs. I can't get access to swaps because this client just can't trade them. For some reason or another, they're not big enough, right? And so I think in my framework, that's how I think of this, which is I think we're going to bring end-to-end multi-asset portfolio construction into the wallet, and it's going to be powered by digital assets on chain. But we have a lot of work to do to get to the assets on chain, right? And so that's my framework and kind of the North Star that I work towards.
Got it. So then, building on that as well, I'm thinking about investability, right, and investments. I mean, Matt, my assumption here is that you're looking at this universe as, opportunities now for you in your seat, right, when you're looking at investments. So how do you view that?
In general, I think it's just formatting is what we're talking about here. And over time, I think that will be something that fades to the background. What we're seeking for is more flexibility in how we invest, more liquidity, which is an extremely big deal. I lead a lot of our real estate investing at Texas Teachers and look across private equity, real estate, infrastructure, and you're seeing the lines between these asset classes blur in terms of how you invest in them at scale. And in general, a lot of the products that large institutions face are packaged for them by the market, by large asset managers. And you limit the ability to have creativity of product design. And so I don't see any reason why, as we improve the ability to customize products, that institutions wouldn't enter the space just because it's formatted in a new way. And what I think we'll see is the ability to customize duration, yield, residual, subordination, governance, all sorts of things that are very clunky and expensive in today's system, and unlock a lot of value. So I think those are the types of things that a large institution like Texas Teachers that we see in the space. And as people become more familiar with public blockchains and understand it's really just software, I think we're generally agnostic to the underlying technology and are looking for better products and services.
Totally. So I guess then really to get there, you need to start somewhere. And there's been a lot of activity, and the previous panel was talking about how, dating back to 2018, people were talking about, STOs, et cetera. But like JP Morgan's actually doing stuff in this space, right? They've got $850 billion of tokenized short-term loans that they've already processed. And the person that's doing that is sitting right here. So from JP Morgan's seat, how do you view tokenization, and how interesting is that?
Yeah, definitely. So from my vantage point, I think two things that Robert mentioned resonate the most. The first is the hundreds of trillions of dollars that exist through real world or regular world assets that get transacted across our rails or through our broker-dealer on a daily basis. And the second is utility of tokenization. So those two constructs for us, because we're able to see or trade or service those assets on a daily basis, we can also see and experience the limitations of how those assets can be utilized today. So thinking about what you mentioned, JD, around the $850 billion that we use for short-term financing today, the use case there was centered on a limitation that we experience with respect to treasuries, an asset class that most of us would probably think are pretty liquid, transacted in the order of trillions on a daily basis, but still face a limitation in utility in terms of how they can be used as short-term collateral when considered upon the duration of a few minutes or a few hours within a day. So the use case that we structured was coupling the tool of tokenization with the asset, the real-world asset of treasuries, and then leveraging smart contracts to actually orchestrate that type of trading activity, that type of secured lending and borrowing activity on an intraday basis. And to us, that's really formed or served as the baseline of our thesis around tokenization, which I think in the short term is really around figuring out, what are the assets that we as a bank or our clients are comfortable with, but they want to see more out of in terms of using that asset for margin, using that asset as collateral, driving liquidity in that asset, and how can we, leverage these constructs around smart contracts or what have you to unlock that utility.
Got it. And that makes a lot of sense, right? So Treasury is obviously, kind of backed by the full faith and credit of the U.S. government. They're yield bearing right now, which kind of corresponds, I think, to a lot of the interest that folks have in real world assets right now because it plugs in easily into other ecosystems. So then you start looking at what these different assets are that folks are tokenizing. And there was a recent report that came out from Texture Capital, and it runs through and asks through a survey what those are. So I'll throw out a couple here to the panelists. I'd like to kind of get your read on what you find most interesting. Real estate shows up at 58%, alternative assets at 40%, private company shares at 30%, and there's that big conversation between private and public company shares and the accessibility there. Private equity funds at 30%, and so on and so forth. Down at the bottom, though, you find the most commonly accessible different assets: public equities, commodities, and money market funds. That's probably not a coincidence. So, kind of Robert, just kind of your thoughts on that, kind of picking this off here. Why do you think that looks like that, and what assets are interesting to you in this scenario?
Well, I personally think there's a huge misconception where if you have a study like that, most people say, oh, we want tokenization of the most illiquid, the most esoteric, the most volatile assets. But when you see what's actually happening first and what benefits the most from tokenization, it's the exact opposite. In a lot of ways, it's the most liquid, the most stable types of assets. The first asset in my mind that really nailed the RWA transition was stablecoins, a simple dollar that does nothing, doesn't go up. It just sits in a bank account. That was the first killer use case for tokenization. I think the next major use case are non-volatile assets and securities, treasuries, the things that also don't really go up, but provide a financial return. I personally think, the whole, results there are completely inverted. I think, it's more powerful to tokenize something that's stable because it's easier to program, it's easier to make it integrate into other systems. An extremely illiquid or extremely volatile asset, I think, has less benefit of tokenization. And so I think this just shows when you ask people what they expect versus what the market forces draw out of an industry, it's sometimes very different. And that's an opportunity for entrepreneurs.
I actually agree with that, because when you're doing something new in terms of the technology of how you're investing, you don't want to have a lot of volatility in the underlying asset or the underlying cash flow, because you introduce a lot of risk for those new customers that are trying something new to have a bad experience. And I think that's why we've typically seen the debt capital markets lead innovation. So things like mortgage securitization, you can kind of work through it in terms of the history of finance, and I would expect it to be the same thing here, because you have a very low volatility outcome on the underlying investment, so you can experiment with that instrument. It's really difficult to do real estate with respect to this tokenization model today. I think a lot of it has to do with the underlying property level information. And we were talking about this, we looked at our portfolio, we own about $50 billion of real estate at Texas Teachers, and there's a definition for cash flow called net operating income. That is the income stream that you price with the cap rate to value a building. And when we looked through our underlying portfolio trying to clean up our information, we realized we had that defined 27 different ways from our developers and operators. So when you're trying to price an asset across this very disparate base of projects, every project is different, it becomes difficult to do because you're not speaking the same language. And so I think there's a lot of complexity in alts, private equity, infrastructure, real estate, again, that has to be approached from a data perspective to standardize so that you can kind of speak the same language as you value it. And it's been achieved. You look at the public equity market, you look at the REIT market, these things are traded daily, but they're valued quarterly. So I don't think it's this impossible standard for the industry to meet. It just does not make sense to start there. I think you want to start, like as you said, Robert, with something that is much better understood.
Yeah, you can't, there's only one maybe asset class or trend we've seen that has successfully created a market out of thin air. That's crypto in the last cycle, which we've all seen. Basically, how do you create a market and liquidity around something that basically is an idea, right? And you incentivize it. Like you pump money into it, you create yield farms, the whole thing. Right? So we've seen that technology work. That doesn't work with private markets, right? To create a market, it takes a long time, and you have to have lots of participants, and you need people to build experience on the tooling around market structure. You need to make sure there's not one buyer. You need to make sure there's a lot of buyers, right? And an ecosystem around an asset. So tokenizing real estate is great. It's interesting. There's a pretty big gap between the underlying asset value and what you see on chain. And as soon as you get that through that thin layer of traders who might be on there, right, the thing's not going to trade. And I think that's the fundamental maybe misunderstanding is, in the quest for exploration and learning, we've gone in and tooled our way into tokenizing things that actually have the most room for change, right? We know that tokenization is going to change private markets in a really big way, but that's a 20-year cycle. And we're 5 years into it, maybe, right? So the stuff that really works is I think you take your cues from the ETF, the evolution of ETFs as a product category, which was maybe the last big innovation that we saw in finance. It's a $10 trillion product category today. It was nothing in 1995. It was $1 trillion in 2010, right? And so we added $9 trillion to your product category over 10 years, due to economies of scale. But it started with liquid, standardized indexes, right? That everyone knew how to trade. There was a robust market ecosystem built around it. And then people got comfortable with how our wrapper works and how you can take the underlying assets out of the wrapper and you can put them back in, right? And then market makers said there's money there, right? I want to be there all the time. And then you had a really robust ecosystem of liquidity and arbitrage and incentives so that you always have a liquid market around that particular piece of technology. I think we're going to see tokenization play out in the exact same way. And I'm biased because I spent most of my career in that business. But I really do think that's the playbook. from my perspective. But there's a lot of tooling in private markets that I think we just haven't really seen show up yet around off-chain data and creating new markets within that space.
Yeah, well, I'm certainly a believer in that as well, obviously. We started working on a tokenized treasury in 2018. And the thesis there is simply that the wrapper that was created through the mutual fund under the 40 Act that moves to the ETF will be replicated again in this space. And we coined the term the BTF. But we did that specifically because we thought it'd be a catalyst, right? And we thought that'd be a catalyst by using familiar different instruments that large-scale financial institutions would understand, that they would gravitate to, because we thought that would be a way to bring others into the market. I mean, I'd ask this group right now, and maybe even starting over here, but like when you think about what those catalysts are and how you start bringing in widespread adoption from institutions, which many in this room arguably will say will be the tipping point, what do you need to do, and what are those catalysts that kind of we have control over that we could actually try to create and influence?
Yeah, definitely. And I think my answer to this question is also going to touch on the previous question a little bit. So just rounding out from the previous question, I think there's two kind of comments that I'd want to make. The first is that while I completely agree that the first kind of order of tokenization will take place with the more liquid, with the more the higher demand, the less volatile types of assets, I definitely don't think that means there's not an opportunity, and a very large opportunity, in the alts and private asset space. But I think in order to get there, you first need to bring on those assets and those institutions that are like driving that demand, right? So you need to bring on the treasuries, you need to bring on the stablecoins, and you need to bring on the first movers that have the sizable amount of capital to actually, then bring on their clients and then cause that ripple effect across the industry. The other piece that I think you need to introduce through that first order effort is real vetting of the implementation of how you go about tokenizing an asset or issuing an asset on chain. And we've seen a lot of that take place over the course of the last few years in the crypto space, but then attuning that to the specific needs of securities as regulated by all of our fund regulators. That's a very specific challenge that I think would need to be solved in order to further drive adoption and function as a catalyst in the space.
Can I comment on that? I think the catalyst is going to be crisis for most of the investors. And what we're going to see is when there's a crisis in bank loans, or a crisis at the banks, or a crisis in the treasury repo market, or a crisis in the equity market due to volatility shocks, right? Those are the catalysts that hopefully we're gonna experience in the traditional sense, and then we're gonna go, hey, those tokens over there, those didn't respond in the same way that the traditional market did, right? Why is that? Why are people still trading these, and there's still a price over here, but I don't have a price over here in my cash market?
Well, we're not short on crises in the markets. Let's hope that this is going to be the reaction to the most recent crises. Robert, kind of looking back at a couple of you said stablecoins were the first killer use case. We heard that in the first session as well. What was number 2 or number 3 or number 4 for you? What else have you seen that you think is really provocative?
Well, I think we're in the first inning of non-dollar RWAs. So far there's nothing in my mind that has really started to achieve product market fit. There's 100 different experiments right now with tokenizing treasuries in some format. None of them have really achieved much scale, and I think scale in my mind is measured at $1 billion. Stablecoins are at 120 billion, and that's still small in the scope of things. So I would say the only thing that's been successful so far are dollars. We haven't even seen foreign currency stablecoins succeed in any semblance. The attempts to tokenize gold, there's been a couple of them. Those have all failed. Real estate, has gone nowhere. So I would say the only thing that's been successful so far is a simple US dollar. And there's a lot of things on the cusp. Right now, the most explored space in all of tokenization is without question treasuries. And there's going to be successes there. But that might be the second successful asset. And I don't think it meets that bar yet.
I think you have to look where you're solving a customer's problem that is really important to them. And one big thing that I'm in general paying attention to is the lending markets, especially someone that was borrowing from a bank that is very, very likely to be less involved or exiting the market in things where they've been active in the past. And so if you're solving if a customer needs to buy a home or someone needs to access capital to finance their real estate deal or their company or their payroll, they're going to be less sensitive to the technology that allows them to access that capital if they have no other options. And so I think there's a lot of areas out there that are underserved in the world today that are big markets that if you're able to, I guess, kind of abstract away the blockchain element of it, the tokenization element, and just say, hey, I'm providing access to capital, and here's the way that we do it. I think that's an important place to focus because you're going to have a willing customer that is limited in alternatives and will be more inclined to try your product. I think trying to just force legacy, traditional players who are in many cases agents, not principals in their businesses, the incentives are not there to try it out. And so you either have to provide much better returns, much better pricing, or a product that's not otherwise available, or I think it's going to be pretty hard to get adoption.
Much better returns, a product that's not available. I think now about like a lot of the offerings that are out there, even some of the offerings that were out there in the very beginning, right? You had some VCs that tokenized their own equity, like Spice VC back in the day. You also had blockchain science that was out there. There was blockchain capital as well that were leading the way. But that's kind of dried up. We haven't seen more of that. And that would be providing access, I think, to markets that other like smaller retail investors probably couldn't get. Are those motions things that you expect to come back again or that you want to see more of, Matt? Or like what's the ideal thing for you right now within a tokenized asset?
I think it's just a really small market today, but it's clear that the large asset managers, the Blackstones, Brookfields, KKRs of the world that dominate our industry from the institutional side, there's very limited growth on the go forward there. They've sort of tapped into that capital, and so they're all trying to access the retail market or the individual investor market. And a lot of those products are just, in my opinion, bad products. On the real estate side, you've seen them move into their non-traded REIT sort of equivalent, and there's a lot of reason why that structure, in my opinion, is inferior to the public markets that individuals can access. But that's a marketing game, that's a distribution game, and I think this would be one much better way to offer those products and services to individual investors, to retail investors. But there's going to be a lot of hesitation and sensitivity to the PR, the media, the politics of it, because they're not going to bet, in some cases, almost $1 trillion franchise on something that could, embarrass them. And there's just not enough margin in it.
Right, so then if you take the KKR example, right, I mean, it seems like, $5 million slug of a very, very big deal, parcel it off, fractionalize it, offer it to investors that otherwise wouldn't have access. Seems like a great idea.
Yeah, see, so it's not really retail there that I think is the big deal. It's for institutions like us. There's a secondary market where you can buy and sell and finance fund positions. So I want to buy into KKR's buyout fund. I want to buy into Blackstone's real estate fund. Okay, fine. Once you have it, it's extremely illiquid. And if you want to monetize or finance your position, the bid-ask spread there, or the slippage is in many cases 20 to 25%. So it doesn't make much sense. If you were able to improve data and improve and create more of a liquid market, navigate all the subscription agreements, navigate all the legal challenges that exist, which are huge. I spend way more time than I would like on legal in an investing seat at TRS. That would be massively valuable to institutions, and that is a big market. I think that's where you start. And then once you get that technology in place, then you can offer that product to retail, and you have to deal with all the regulatory BS that comes with it. But that's the better place to start.
Totally. And one more question then, and then we'll kind of keep moving around here. But one more question then on that is a follow-up. Wouldn't you think that like blockchain would provide that form of liquidity, right?
Oh yeah. Okay,
good.
I mean, that's one of the things that excites me about crypto. It's why we're actively investing in the space. It's very clear that this is a step function improvement over the legacy system. And that's why people like TRS need to be customers. Startups need customers. And so part of what we're trying to do is figure out ways to incrementally test products, incrementally get involved in the ecosystem, because it's very, very difficult, if not impossible, to kind of go all in at an institution that is understandably risk averse.
Just to underscore a couple of things that Matt said around the standardization of data and the ability for, once like these different institutional asset managers are able to get it right for the institutional investors, bring that forward into like the high net worth market or retail investors as well. I think from our vantage point, like being, having one of the like largest private banks, being a distributor of those products directly to high net worth clients, we can see that like those needs resonate among our client set as well. And so if we are able to get it right for the likes of a TRS, those same rails, and I think that this comes back to like the point around blockchain, those same rails can be extended to then offer that share of a fund and that utility around the fund to the high net worth clients.
So I guess that then brings up kind of one of the things that Colin talked about earlier, right? Which is kind of like some of the obstacles and challenges, and one of them could be, kind of this development in silos, right? This public blockchain versus this private blockchain conversation that's out there, and arguably some could say that it's stymieing the ability for innovation. Others would say that right now kind of folks are incubating amazing different projects and different processes and different flows that once they're ready for prime time will help to really further advance where we are. Anthony, kind of you sitting again, you've got a great view because you sit there and you kind of look at all these different, participants in your marketplace and have, a great vantage point to see what's happening there. What's your thoughts on that?
So I think so I've got like 3 jobs. So one of them is I serve our asset allocator clients, from pensions to family office. I run capital introductions, so I try to help our crypto hedge funds and VC funds meet LPs. Who are interested in investing, and then the tokenization thing. Now, in my mind, it all kind of comes together as portfolio construction in terms of like, why would an allocator want to participate in this entire thing, right? And so they typically today have their venture exposure. We think hedge funds are going to become very interesting as an alpha extractor going forward. And then the rest of it's tooling, right? And so for an allocator, it's a function of like, well, I already have exposure to all these asset classes. You're not bringing me anything new, but can you give it to me in a cheaper, more liquid, more transparent wrapper, right? And that question becomes interesting for people, right? To Matt's point around how do you make a giant, multi-$100 billion pension more efficient, right? So they can pay benefits to the beneficiaries. And so for the larger allocators, the question's always around private markets today. It's like, well, my liquid book's pretty fine, it's fine, right? I don't really have that much to do there. My alternatives book is where I have problems. I don't have liquidity. And so that's their focus, really, is like, come to me when I've got options on my private markets. Everyone else is focused on the liquid side, and rightfully so, because people want fast money, right? The biggest problem with this entire space today, I wouldn't say it's a problem, it's just early, is distribution. We're in the 95 era. When I got my first computer in like 94, right? I came home from school and I was like playing Diablo or something, right? And I was one of 100 million people at the time that had a computer, right? In a world of billions. And so here we are today, we have a couple 100 million people with wallets. And I think of it the same way, and Coinbase has been a really important thrust into giving people wallets. And so I think we're on this destiny of like, we want to bring 1 billion people on chain, which means we want people to be connected, right? It doesn't necessarily mean we're all clicking into the UI that Ben talked about, which is a pretty poor experience for retail. But we're connected to assets that are powered by an on-chain experience. And then we need to give people wallets. And institutions have to give people wallets too, because just because they build a blockchain doesn't mean that they can actually distribute digital assets which run on completely different rails to their users, right? And so I think the conversation is broad enough to where we're talking about like giving people broadband computer infrastructure, even wallets. We're talking about building stuff and taking traditional assets and fix the tooling to make it really efficient and low risk, hopefully. We're talking about giving people access to new markets. So if I'm a borrower and I need to access bank line of credit and they cut me off, right? Can I go on chain and do that, right? Centrifuge hopefully will power that. So I think the conversation is really broad, and that's my perspective on it. So
totally. So Robert, then let's talk about it. So we're thinking about how it is we get people to start, becoming more proficient, really, right? And one way is obviously education through wallets and things of that nature. What else has to happen in order for us to get to this $16 trillion kind of market that kind of Bank of America is predicting by 2030?
Well, I think the biggest motivator for people to adopt a new technology is always going to be financial. I look back at the last couple of years in crypto and DeFi, and the crazy user experience hoops that people jump through for an extra 3% were mind-boggling. Like, I saw people solve very challenging problems to eke out a little return. The ingenuity of, the degens is astounding. But that ingenuity existed because there was a financial incentive or an opportunity for them to figure it out. I mean, people used Curve. Like, have you ever seen a worse product? And so I think the same logic applies in that people are going to adopt something because they get something out of it. They're not going to do it because, an executive made a slide in a boardroom. No one cares, right? People are motivation based. And so what's going to cause the next billion people is when there's opportunities at scale. And it's about unlocking access and usability in ways that they haven't seen yet. Otherwise, they're not going to care. There's no reason for them to use crypto. There's no reason for them to have a wallet.
Does opportunities at scale equate to PayPal entering the equation with your killer use case? Does that help this?
It can't hurt.
Yeah, I think we're going to see, stablecoins are interesting because there are a few assets in the world where the issuer gets to keep 100% of the profits from it, right? And there's a lot of people that really want to come into this space, which, Coinbase enjoys a nice seat, and there's some other players outside the US that enjoy a nice seat. Regulations are going to make that one really unique as well, because each jurisdiction is going to have their own version of what they think is the right issuer rules around stablecoins. People want to control their money. So PayPal coming in is just one small example of somebody else coming into the space to bring the tooling to distribute the technology to their users. What's really great about it, and like crypto is phenomenal for this, is attracting those next users to get a wallet, right? It's like computer games. Like I wouldn't buy one otherwise. I'm going to play games, right? I'm going to go buy a computer. So I wouldn't get an iPhone unless I needed to talk to people, right? So I think crypto has been phenomenal about onboarding people, and I actually hope that like crypto continues with real use cases, with real utility, so that people continue to dive into trading digital assets and investing in space, because that's the onboarding mechanism. We're not going to get them into this ecosystem in any short order with traditional assets, because they already have them, right? And so I think that's an important point. And so Coinbase launched Base, and Base is a massive unlock for us to bring, as Brian Armstrong calls it, and Jesse will talk about later, just to bring our users out into Web3, right? Because today they're inside of our ecosystem. We can do so much. Scaling's hard, engineering talent's hard to find, right? We can't build everything. So I think Base is this really unique opportunity for everyone to come build, right, on our chain and other chains, right? And we're going to try and bring our users out, and hopefully we can continue to funnel in new users and make that a net add.
So there's stable tokens, and then there's also the conversation regarding tokenization of money, right? And JP has been very much on the forefront of that, and I don't know how much of that's public or not, and I'm not trying to break news here. It's simply things that I read, and I don't know where it's generated from. But there's also kind of the announcement from Citigroup just earlier this week about how their RLN network has gone live, and how they're really trying to push forward tokenization of money, and that's client accounts and allowing them to do things a la Signet or Sen, et cetera. So, am I misreading that? Is that a big initiative? Do you think that's important, and why?
Yeah, definitely. So it is live and it is public, so we're good. It was, I don't know, aptly or not aptly named JP Morgan Coin, but it's actually just cash on chain. So unlike a stable coin, that might not be treated on your balance sheet in the same capacity as a deposit liability, which is effectively what cash in your bank account is. It's your claim against the bank to get your cash, to get the actual dollar at a future point in time. We saw a need when we were building out our first sets of use cases that we needed this true actual representation or actual asset of cash on chain. For our use cases, be it the secured financing use case or be it some of the efforts that we've had in digitizing bonds, we needed what was being traded against that asset to be held by an investor in the same capacity that they would hold cash when trading in regular way markets. So I think we see a lot of potential for stablecoins and a lot of need for stablecoins, because that's when you get to that true atomic DVP, in a single transaction, my asset is going for that representation representation of cash. But for our capacities, it was really in bringing that same construct of the deposit liability on chain. And I think what that does is just unlock additional options for investors or folks who are able to hold the different types of assets to have that like non-volatile representation of cash, be it through a stablecoin, through a money market fund unit, or through something like JP Morgan Coin, which is like deposit liability on chain.
Got it. And then, so you guys opted to do that on a private permission blockchain.
Yes.
And maybe there were reasons for doing that, or what's the motivation?
Yeah, I mean, primarily regulatory. So the different use cases that we talked about in JP Morgan Coin, they run on a private instance of Quorum, which is effectively just a fork of Ethereum. I think internally, our team, sees a lot of potential, a lot of opportunity, and our direction of travel. We take a lot of inspiration from what's happening in the public space. But from a legal, regulatory compliance, getting everyone comfortable, and that's not just ourselves, but our regulators and our clients, those who might not, even be at the conversation of thinking about this technology at the same level as folks in the audience today. The approach that we took is let's actually create real live products on a permission chain, and at which point in the future it might make sense to pivot. Let's make sure our products are built in a way that they could be deployed on a public chain as well. I like to joke with my team and be like, let's build our digital asset platform as a protocol, and then eventually we can just like switch out the blockchain underneath.
Perfect.
Yeah, I think there's a trend there too, right? Which is, so we have a blockchain, they have a blockchain, City's got a blockchain, right? I think this is gonna be something that, like stablecoins, everyone's jumping into, that we figured out that you kind of need this tooling environment as a large institution to make it easy for you to explore, build assets that are not kind of inside your ecosystem. So I think you'll see more and more of the institutional blockchains, whether they're public or private. I don't think matters right now, right? I think the important thing is that big institutions are starting to flex those muscles and figure out how to hire the right people and build the tech.
Awesome. So, Matt, in our prep session, we were talking, and you talked about it a little bit earlier before, and you said that, if we do it, it's not necessarily always the institutions, right? The biggest ones that are out there, right? That are going to be leading, and the ones that are actually going to be, kind of innovating here. From your perspective, I mean, when you look at it from investing, right? Is it, side pocket? How do you see that? I mean, how do you look at, kind of if there are opportunities for you that are out there, if there are places that you want to invest, how do you really perceive, fractionalization, and how is it that you could use, kind of real world assets to, further enhance your toolkit?
So I'm not sure I'm going to even answer that question, but I'll tell you kind of what I think makes crypto such a step function better, that it's where people will inevitably go. I think it's this idea of all data being organized in one place, so being pulled out of these different silos and environments. Value is information, just like anything else. It just happens to be stored in a very heavily regulated and segregated series of databases. Part of what excites me about this whole industry is having all that data coming back. And if you think about how people are paid and compensated, it's for their time. That's what an employer is doing, with your job. That's what Web2 is doing, selling you ads. And so I think the big unlock that I see here is all this information being brought into one place, being publicly available, being standardized so that people can build products and services in this much broader, globally connected ecosystem. I think that's a really big deal, and it is hard to even foresee where that leads us. But if you believe that, the 2+ billion people who don't currently have internet are going to be brought online in the coming decades, it's going to be mobile first, everyone's going to be connected, there's going to be a lot of competition for those people's time and attention. And I think if you believe in an increasingly automated internet, an intelligent internet, which is really automated through artificial intelligence, which I believe in, I think there's no shortage of interesting ideas and proposals that will be made to you for ideas that you never would have had yourself in the first place. And you've seen some of that begin through fintech over the last decade plus, and I think we've just begun to scrape the surface of what's possible with that technology. So what I'm envisioning is an integrated labor market, education market, investment market, just the market of all information, that is then available and discoverable for the world to build upon. And so I don't think institutions really matter in that traditional sense once these markets are established. I actually think that the early market participants will be the people that Robert and Coinbase are trying to serve, which are the people that are in this room, which are early adopters that see value, or they think it's cool, or they think it's interesting. And I think there's enough capital there, and there's enough scale there that you will have an ample base for developers to build upon. And once the world sees the potential of these products and services, I think there'll be a way for an institution to bridge there. And to answer your question, there's all sorts of ways to play the game. Typically those involve customized bespoke structures. We call them separate accounts or side pockets, where you hire a manager, you create a system of governance to effectuate whatever strategy you want, and then the underlying assets and the underlying operations are delegated to that manager. I would fully expect that to be the way most large players enter the space, which is completely fine and totally irrelevant to the outside market.
All right, jumping in. I don't know if my mic's on, but we do have a question from the audience that I want to make sure I'm good, I think. I don't know. Is this thing on? It's supposed to be on. This is from Nathan Howard. How do the panelists think about public blockchains, permissioning, and private blockchains? And how will that paradigm play out for institutional adoption?
I guess I'll start. I think institutions are cautious and conservative by nature. I think in general, institutions will prefer a spectrum from private blockchains to permissioned to open in that sequence. I don't think it really goes the other way. I think you have a lot of activity building out each piece of this spectrum right now, today. You have people building private, you have people building permission, you have people building open. And the comfort that institutions have is just going to continue to increase adopting, going through that journey. But they're going to start conservative. And I think in 20 years, are they going to use open blockchains? Absolutely. I think any investor is going to be comfortable using a wallet, on a public ledger, because that's where you're going to have the greatest network effects. That's where you're going to have the most applications, the most assets, the most programmability. It's all going to end up there because that's where it has the highest network effect and utility. But it's going to be a transition to get there.
Public chains will drive network effects. Private chains will be around. They will not drive network effects, but they have deep user bases and deep assets. And I think most institutions, to your point, are cautious. They need a safe place to play and to serve their clients and protect their clients' assets. But when they need to access liquidity, they're going to go to the place where the network effects accrue.
Yeah, if it's not public blockchains in the end, I don't think there's any point. But it's also the way communications networks began. It wasn't this globally connected internet when the industry began. I don't know why this is any different. So I think you're right, and they'll begin in all sorts of ways that are highly inefficient, but will allow folks over time to be in a connected series of public blockchains, which is where it has to end up.
Yeah, I echo these thoughts. I would say private and permission blockchains are like the testing ground or the playground that institutions need in order to get comfortable with how to interact with smart contracts, how to tokenize assets, so on and so forth. And they're also again, that experimental ground to figure out what's the right layer of permissioning to bring forward into public ecosystems. Like, just because you're operating on a public blockchain doesn't mean everything that you need to do needs to be available to every other person on that network. And I find it hard to imagine a world where institutions are completely okay with everything being completely open that runs through
Zero
the
chance.
rails. Yeah.
Zero chance.
It's a nice way of saying that, I guess. But I think in order to get to that state where you're getting all the benefits of operating on public infrastructure, which I completely agree with Matt is the whole point to begin with, you need to have that expertise built up first.
And I think that this panel intentionally left regulation for experts that are out there. But let's also remember that there's a ton of pressure on these large financial institutions to not develop on public blockchains. And in fact, it's very stern.
For now.
Let's end it there. Thank you very much.
Thank you.